It's the spring of 2006 in North Philadelphia. The street is narrow. The row houses are old. On one of those porches, a woman in her 60s named Jenny Halliburton signs a stack of papers. She has lived in this neighborhood most of her life. She gets $1,766 a month from Social Security. That is all the money she is coming in. The papers she is signing are a mortgage from a company called Countrywide Financial. Her first payment is going to be more than half of every dollar she earns. This mortgage was approved by a computer system inside Countrywide. The salesman typed her information into the screen. The screen said yes. The papers came out of the printer, and she signed them. The whole thing took less than an hour. A year later, in March of 2007, Jenny Halliburton's name is read into the record of the United States Senate. A Philadelphia legal aid attorney named Alan White testifies on her behalf at a Senate Banking Committee hearing. He tells the senators that her loan was unaffordable from the day she signed it. The committee thanks him, and the hearing ends. 18 months later, Lehman Brothers collapses and drags the country into the worst recession in 80 years. About 4 million American families lose their homes. According to the Federal Reserve's Survey of Consumer Finances, the median American family lost nearly 40% of their net worth, wiping out 18 years of accumulated wealth. By the end of this video, you are going to understand the machine that approved Jenny Halliburton's loan. You are going to understand why Wall Street is building the exact same machine again, this time with AI. And you are going to understand why the people building it are insisting that nothing can possibly go wrong. Countrywide Financial was the biggest mortgage lender in America. A man named Angelo Mozillo ran the company. By 2006, Countrywide was approving so many loans so fast that the federal government would later sue them over how it was done. The salesman who took Jenny Halliburton's application did not have to call her employer. He did not have to verify her income with a tax return. The loan she got was something the industry called a stated income loan. The borrower stated the income. The salesman wrote it down. The computer approved it. And the salesman got paid a bonus based on how many loans he closed. Then, in 2007, with the company already starting to wobble, Countrywide launched a new internal program. They moved certain loans into a faster track with less paperwork, fewer checkpoints, more volume, more speed, and Countrywide gave this program a name internally. You are not going to believe what they called it. They called it the hustle. According to a complaint, an internal Countrywide review from January of 2008 found that on certain categories of these fast-track loans, the default rate was approaching 70%. Executives knew what was going on, and the loans kept getting sold to Fannie Mae and Freddie Mac anyway. What broke in 2008 was not just one program at one company. The hustle was just a symptom. The disease was an entire industry that had figured out how to make decisions faster than any human could check them. Across the country, mortgage lenders had replaced veteran loan officers with automated underwriting systems. The systems had a few input boxes: income, credit score, home value. Employees who got paid bonuses based on how many loans they closed quickly learned which inputs to change to get the machine to say yes. They tweaked and retyped. They made the numbers fit, and the volume exploded. Between 2000 and 2007, Wall Street firms packaged roughly $2.1 trillion worth of subprime mortgages into bonds and sold them around the world. The bonds were rated as safe by ratings agencies who were being paid by the people selling them. The Federal Reserve kept interest rates low. The bonds were bought by pension funds, by foreign governments, and by retirees. When the loans that the machines had approved started defaulting at scale, the whole structure came down at once. Lehman Brothers, Bear Stearns, Washington Mutual, all of it. The Treasury Department had to step in. The stock market lost trillions. About 8 million Americans lost their jobs. Bank of America bought Countrywide in 2008 to keep it from going bankrupt. The Justice Department later sued Bank of America over the software and won. The settlement was over $1 billion, though parts of it were later reduced on appeal. Angelo Mazzillo paid a $67 million settlement to the SEC for civil charges and was never criminally prosecuted. He died in 2023. Let's fast forward to 2026. Wall Street is building the same machine, this time with artificial intelligence. After 2008, regulators forced the big banks to slow down. The banks had to keep more capital, they had to verify income, and had to write down their losses. So a different industry stepped into the gap. They're called private credit funds. Firms like Blackstone, Apollo, Ares, Blue Owl, and KKR. As of 2026, they manage approximately $1.8 trillion in loans. Because they are not regulated like banks, every loan they make is private, which means the public never sees the terms, the borrowers, or the losses until the losses are too big to hide. These firms have a problem. They have grown so big, so fast, that they cannot underwrite loans the old way. They cannot have a 40-year-old loan officer call the borrower's CFO and look at the books for 3 weeks. They are competing for deals against each other. They need speed. So in 2025 and 2026, the biggest private credit firms in the world started rolling out artificial intelligence systems to do the underwriting for them. Blue Owl Capital, according to industry reporting, uses an AI platform that pulls data from SEC filings, loan documents, credit history, and market data and generates a risk score in minutes. Blackstone has built its own internal AI risk scoring framework. Apollo has integrated AI into deal sourcing and portfolio monitoring. Ares Management has rolled out new AI frameworks to evaluate borrower exposure, and the lending industry has a new slogan for what is happening. According to a Gartner report from 2026, the standard for underwriting has shifted from, quote, days to decide to minutes to approve. The same words Countrywide's own employees used about the hustle. There is a difference between a loan and an underwriting decision. The loan is the money, $500 million to a software company, $50 million to a manufacturer, $2 billion to a data center. The decision is the answer to one question. Can this borrower actually pay it back? For 2 centuries, the question was answered by a person. A banker looked at the business, the management team, the customers, the cash flow. He looked at the economy outside his window. He looked at his own gut. And if he said yes and was wrong, his bank lost money, so he had a reason to be careful. When you replace that person with an algorithm, 3 things happen. The speed goes up, the volume goes up, and judgment goes down. The algorithm has never lived through a recession. The algorithm has never seen what happens when the customer base of a software company gets eaten by ChatGPT in 18 months. The algorithm only knows what it was trained on, and it was trained on the last 15 years, which, by historical standards, were the easiest 15 years to lend money in recorded history. In 2026, multiple private credit firms told investors that their AI models had reviewed their software loan portfolios and concluded the risk was, quote, low, medium, or minimal. Those models were trained on a world before generative AI existed. They are now being used to tell investors how safe those loans are in a world where AI is destroying some of the borrowers in real time and the losses have already started. In February of 2026, when the AI company Anthropic launched a product that could automate legal, sales, marketing, and data analysis work, the entire private credit sector sold off in a week. According to Alternative Credit Investor, Blue Owl's stock fell 13%. KKR, Ares, Blackstone, and Apollo all dropped between 8 and 10%. Bloomberg later reported that an analysis of disclosures from 7 major private credit firms found at least 250 investments that should have been classified as software loans, but had been labeled as something else such as business services, tech-enabled services. The labels disguise the actual risk. The money inside these private credit funds does not all come from billionaires. Some of it comes from your state pension fund. Some of it comes from a retiree's brokerage account. Increasingly, the firms have been marketing these products directly to wealthy individuals through what are called BDCs, business development companies. In the first quarter of 2026, the Those individuals tried to pull their money out. The firms gated the funds, meaning they refused to let investors take their money back or only let them take a fraction. Blue Owl permanently halted redemptions on one of its tech-focused funds. UBS analysts warned in May of 2026 that AI-driven defaults in private credit could reach tens of billions of dollars in 2026 alone. The same thing happened in 2008. In a different corner of finance, the funds gated, the redemptions froze, and then the losses came. Here is the lesson nobody on Wall Street will say to your face. In 2008, the disaster was not that lenders made bad loans. The disaster was that they built a system that could not tell when a loan was bad. They replaced the humans with software. They paid bonuses for speed. They labeled the risky loans as safe. And when reality finally arrived, the entire structure collapsed because every firm was using the same machine. In 2026, the biggest names in private credit are converging on the same underwriting standards, the same deal types, and increasingly, the same AI tools. A May 2026 industry analysis found that Blackstone, Apollo, and KKR are writing nearly identical loans. The industry has built one machine, and it is making one decision over and over across hundreds of billions of dollars. The men running these firms today, they are not bad people. Many of them lived through 2008. They believe their machines are better. They believe their judgment is sharper. They believe their AI models are smarter than the algorithms Countrywide used. Maybe they are right. Or maybe the lesson of 2008 was never about subprime mortgages at all. Maybe the lesson was that any time Wall Street builds a machine that can say yes faster than a human can say no, a machine that is paid by speed, that hides its failures in private books, that nobody on the outside can see into, that machine eventually breaks the country it was built inside of. Jenny Halliburton's name went into the Senate record in March of 2007. A legal aid attorney spoke for her. He told them the loan was unaffordable from the day she signed it. 18 months later, the country found out he was right, and it took 8 million American jobs with it. The next round of testimony is already being written. We just have not heard it yet. If you want more stories like this one, the real history of how Wall Street builds the same machine, breaks it, and builds it again, hit subscribe. Every week we tear apart a deal you thought you understood and show you the people who actually paid the price. See you in the next one.